Hello, and welcome back to the Quantamental Investor YouTube channel. Today we're going to dive deep into Microsoft Corporation and its recent performance. Since the turn of the year, Microsoft's stock has performed largely in line with broad equity indices, such as the S&P 500. But there's an elephant in the room. Microsoft's stock is currently trading at a high multiple of around 43 times price to free cash flow. To give you a sense of scale, that's a multiple we've only seen during the peak of the liquidity bubble in 2020 and 2021, and back during the dot-com bubble of the late 90s. Adding to this, with long-duration treasury yields hovering in the 4 to 5% range, Microsoft's equity risk premium is currently negative. Essentially, the market is betting that Microsoft's stock carries less risk than the US government. Yet this situation is unsustainable given the immutable laws of money. Sooner or later, Microsoft's equity risk premium will need to turn positive. Now let's take a closer look at Microsoft's Q3 FY2024 report. Unpacking the numbers, we find a healthy financial performance. Microsoft reported total revenues of $61.86 billion. That's a year-over-year increase of 17%. Their diluted earnings per share also rose, reaching $2.94, which indicates a 20% increase from the previous year. What really stands out, however, is the performance of their Azure Cloud business. This segment grew by a whopping 31% year over year, clearly demonstrating the increasing momentum of cloud computing and generative AI in the tech industry. But it's not just Azure that's on an upward trajectory. Microsoft's Intelligent Cloud segment as a whole saw growth too, increasing by 21% year over year to reach a total of $26.7 billion. Microsoft's CEO, Satya Nadella, encapsulated the success of Azure, stating, "Microsoft Copilot and Copilot Stack are orchestrating a new era of AI transformation, driving better business outcomes across every role and industry." With Amy Hood, Microsoft's CFO, adding, "This quarter Microsoft Cloud revenue was $35.1 billion, up 23% year over year, driven by strong execution by our sales teams and partners." So the story of Microsoft's Q3 FY2024 report is one of robust growth, particularly in the cloud computing sector. It's clear that Microsoft is solidifying its position as a leader in this space. But what does this mean for the valuation of the company's stock? Is Microsoft a buy, sell, or hold? Despite Microsoft's strong financial performance, our valuation model suggests that the stock is currently overvalued. This statement may seem counterintuitive given the company's recent robust growth, but let's delve into the numbers. Our valuation model, which takes into account a multitude of factors, including earnings, growth prospects, and risk profile, estimates Microsoft's fair value to be around $320 per share. This represents a potential downside of approximately 21% from its current trading price, so even though Microsoft is doing exceedingly well, the market price of its stock appears to have outpaced its intrinsic value. Now let's turn our attention to the expected returns over the next 5 years. Given the company's current valuation, our model predicts a lower return than risk-free government treasuries. This implies that the risk associated with investing in Microsoft at its current price is not compensated by its potential returns. So, what's our recommendation? Well, Microsoft is undoubtedly a phenomenal company. It's delivering robust growth at scale, and its Azure Cloud business is showing incredible momentum. However, the stock is quite frothy. Our analysis suggests that now might be a good time to tactically sell Microsoft shares at these levels and wait for a better entry point through a price or time correction. In conclusion, while Microsoft's business is performing exceptionally well right now, its stock has run up too far, too fast. With the stock trading at a lofty price to free cash flow multiple and the company carrying a negative equity risk premium, the market seems to be overlooking the inherent risks. Our valuation model suggests a fair value estimate for Microsoft at around $320 per share, a significant downside from its current trading price. While the company's robust growth, particularly in its Azure Cloud business, is undeniable, the current stock price does not offer a compelling risk-reward balance. Therefore, it might be prudent for investors to consider a tactical sale and await a more favorable entry point. So, if you found this analysis insightful, Don't forget to give this video a thumbs up and hit that subscribe button for more in-depth stock analysis. Thanks for watching, and we'll see you next time.